Hello, my name is Jacob Sanin. In today's video, we're going to be discovering what is the best tax structure for you as a small business owner. Now, if you are a new business owner or even a seasoned business owner, this video is for you because tax laws are always changing, LLC and state laws are always changing, so be sure that you're up to date on all of the most relevant tax and state laws as it relates to your individual situation. Now, there's always so much discussion about what's the best entity for me. Now, that's a loaded question, but today we're gonna try to solve that problem for you individually. We're gonna be talking about sole proprietorships, C corporations, general partnerships, LLCs, S corporations, and really to give you a deep dive on what is the difference between all these entities and what is relevant, what is not relevant, so you could have more confidence in your current business entity and more confidence in potential idea for your next business venture. So let's get into the video. The first business entity that I really want to focus on is called sole proprietorship. It is so important for you to understand this because many people, when they first start a business, they listen to Instagram and they listen to all the video Facebook reels with people saying, oh, start an LLC. That's how you take tax deductions. You must have an LLC. That is somewhat deceiving. It's not 100% true. You don't necessarily have to have an LLC to run a business or to even have tax deductions. Now, by you understanding what a sole proprietorship is, this will unlock a lot of answers for you as what might be the best way for you to get started. Many people with side hustles, maybe they do Uber or Airbnb or something simple like that. Sometimes a sole proprietorship is the best entity for you because it's simple. You don't have to worry about keeping up with LLC organizational documents and fees. You don't have to worry about a separate tax return. You literally just file on a Schedule C, which is basically your individual tax return. So, what is a sole proprietorship? A sole proprietorship literally means that I'm an individual that is doing business. So in order for you to be a sole proprietor, all you have to do is be a 1099 or running a business by yourself, and that's essentially what a sole proprietorship. Any business that you run individually for profit that doesn't necessarily have a tax structure. So what are the advantages and what are the disadvantages of a sole proprietorship, and when would you want to consider starting as a sole proprietorship? Maybe you are in a stage where you're just trying to figure out what might be the best business for you. Maybe you have a lot of side hustles, or maybe you are just a very simple business. That is typically when sole proprietorships come into hand. Now, the advantages of a sole proprietorship is there's very low maintenance cost. You don't have to hire an attorney to keep up with your legal structures, and you also don't have to worry about maintaining your LLC on a year-to-year or any type of other state registration documents that typically could add up if you have multiple businesses. So that's what the benefit of a sole proprietorship is. So how do you even get started as a sole proprietor? You literally just have to start a business, create a business bank account, and you don't even necessarily need an EIN number for a sole proprietorship. The best way that you could start a sole proprietorship is to literally go to the bank, tell them that you would like to open up a business bank account, then you're gonna open it using your social security number, and literally there you have it. If you don't have a business name, you could actually do what is called doing business as and add it as a later date, and now you could actually have a legal business name. Now, depending on your industry and the type of business, there's often a lot of city and state requirements as it relates to registering your business. So you want to make sure that you look into those state and city laws, and so you know all the things that you actually have to register to let the state know that you're conducting business in that state. Now that we're talking about that, there's also other things that you have to consider as well, so like sales tax, use tax, property taxes. Depends on your industry. It depends on the type of business. But be sure to get with a CPA and a legal team so you know what are those individual things that you need to be looking out for when it comes to having a sole proprietorship. Now, what more importantly, I think is what is not a good idea to be a sole proprietorship. What are the downsides to being a sole proprietorship? Now, you need to understand that the downside to being a sole proprietor is you have unlimited liability, meaning that anything that goes wrong within your business, you will be held personally liable for. Now, this is one of the reasons why people will recommend other legal structures, such as an LLC, a C corporation, or an S corporation. We're gonna get into those later in the video, but for right now, let's just be sure that we understand all the disadvantages and why you would not consider being a sole proprietor. The next reason you wouldn't want to be a sole proprietor is you have a partner. If you have a partner that you are operating in, you are now considered a partnership, which also involves a whole nother tax return, which is called the 1065 tax return. So if you are operating with a partner, you will not be considered a sole proprietor, and there's very particular rules as it relates to this in the IRS. So you want to make sure if you're conducting business with anybody else that you guys have a partnership agreement or some type of contract agreement between you two, so legally you guys don't get mixed up as a partnership by accident, because the tax ramifications for not filing as a partnership when indeed you have been a partnership in the eyes of the IRS could be big if you don't stay on top of it. The next thing you need to consider when it comes to sole proprietor is how big you want to build this business. Do you want to brand this business? Is this a business venture that you want to scale? The bigger you scale, the more liability that you have, and that's when you want to consider potentially having an actual structure that will protect you in more ways. And lastly, the most important thing you need to understand when it comes to sole proprietor and filing on Schedule C of your individual tax return is you're going to be subject to self-employment taxes. So the downside to that is you're going to pay 15.3% of any income that you make. You're going to be paying way more taxes because you are a sole proprietor, since there's other entities that you could get into to avoid the self-employment taxes. So it's so important to understand that sole proprietors are subject to self-employment taxes. With all that being said, being a sole proprietor still provides you with many advantages when it comes to tax deductions. You could still look at taking things like the home office deduction. You could take depreciation on vehicles and other deductions. You could deduct meals. You could deduct other expenses that relate directly to your business. Having a side hustle and becoming a sole proprietor opens the door for you to be creative, and now you could look at some of those personal expenses and use them as a legitimate business expense. So for some people, being a sole proprietor might be the best tax structure that you could have. Now, before we all jump on the sole proprietorship bandwagon, let's actually look into some of these other tax structures. Let's talk about a general partnership. If you have a person that you're conducting business with and you guys are both making profit, you could potentially be considered a general partnership, which also is exposed to unlimited liability, which is not necessarily the best when you are thinking of big businesses. You also need to understand that general partnerships are also subject to self-employment taxes. A lot of the rules of the general partnership is very similar to the rules of sole proprietorship, but now you are partners with somebody else and you have to split all of the liability with that partner. So that's one of the biggest things to understand about the general partnership. As mentioned before, you will have to file a separate tax return as a general partnership, which is you're going to be filing the 1065 partnership tax return, which has a tax deadline of March 15th typically. So as a general partnership, you now need to understand that you have two tax deadlines that you have to meet, which is the partnership deadline and the individual deadline, because you're going to be getting what's called a K-1 from your partnership to be reported on your individual tax return, which is also due on April 15th. So there's two deadlines that you have to be aware of as a general partnership. The next tax entity I'd like to discuss is one of the most common discussed entities, which is an LLC, also known as a limited liability corporation. Now, there's a lot of misconceptions when it comes to LLCs, and I really just want to take a deep dive to really straighten out a lot of the things that I typically hear people say. First, let's just get it out the way. LLCs do not save you in taxes, okay? As mentioned before, you could be a sole proprietor, you could be an S corporation, you could be a C corporation. All those entities save you in taxes by you being a business owner. Now you can get creative. So an LLC is not this unique entity that's structured for taxes. LLCs are structured typically for liability purposes, as its name says, limited liability. Now, if you have partners that you're working with, you might want to consider having some form of an LLC. The benefits of an LLC is the flexibility. It allows you to make changes to your operating agreement. You could determine who the liability goes on within a certain partner. You could consider partnership. As an LLC, you're able to get flexible with who gets what profit, what kind of percentages, how our distributions determined. You see, with the rules of the general partnership, they're very strict, and that's why LLCs were created. They combine the rules of a partnership and the rules of a corporation, and you really get to get creative when it comes to your operating agreement for a limited liability company. You really get to get flexible when it comes to the rules of an LLC because it combines the rules of a partnership and the rules of a corporation. You can kind of combine those two and get really creative with how you want to look at each partner and how we want to look at liability as it relates to each partner. You need to understand, as an LLC, you also are subject to self-employment taxes because you are a flow-through entity that is not an S corporation. So with that being said, if you are making active income inside of an LLC, you will be subject to self-employment taxes. Now, if you are into a passive activity, this might make better sense for you as a business owner to be in an LLC because you are not subject to self-employment taxes. So for example, if you're into real estate, this typically is great business structure for you because you're passively investing. If you're a passive investor, you're not subject to self-employment taxes. So as mentioned before, the LLC is one of the most common businesses that typically people have, but it's subject to self-employment taxes, and many people don't know what they're actually getting themselves into when it comes to taxes in LLCs. Now, the unique part about an LLC is you're able to make something that's called an S Corp election, which brings me to the next business entity, which is one of my favorites, the S corporation. One of my favorite reasons why I favor the S corporation is because we're able to avoid self-employment taxes for all active types of businesses. Like I mentioned before, it really depends on the business entity that you have. If you're an active business, you might want to consider forming an S corporation to avoid self-employment taxes. Now, what you need to understand is there's income limits and thresholds for this S corporation. You want to be making about $40,000 to $50,000 typically of net income before considering transitioning to an S corporation. So that's why when you're first getting started, maybe a sole proprietorship or a regular LLC might be most beneficial for you if you're expecting your business to not be over $40,000 to $50,000. But now, if you're an active business, right when you cross that threshold, you want to start thinking about making an S Corp election. This S Corp election is done through Form 2553 if you are an LLC. Once you're an LLC that is taxed as an S corporation, now you're going to be paying yourself what's called a salary. Now, this salary has to be reasonable. The benefits of paying yourself as a salary is now you're no longer going to be subject to self-employment taxes, and instead of paying 15.3%, you're going to be paying about 7.65% on a W-2 that you will receive from your corporation, which will be deductible to your business. That is the benefit of an S corporation. There's also more strategies that it relates to S corporations and paying yourself and how to leverage retirement accounts and other things like that, but we're not going to get deep into that today. We're literally just going to be talking about the foundation. Now, as an S corporation, you're still protected from liability in terms of the business. So people cannot go after your personal assets unless you pierce the corporate veil. If you don't know what piercing the corporate veil means, it basically means that, hey, you're not really operating like the business that you say you are. So that's why I typically recommend having a separate business account and don't intermingle it with your personal expenses. You really have to run your operation like a business, having things like board meetings, making sure that you're filing your corporation documentations on a yearly basis, keeping up with any other fees that you have to keep up with in order to be a legal structure. You need to be making sure that you're doing those things so you don't pierce the corporate veil, and you will also be exposed to unlimited liability if you were to be sued or somebody tried to come after you and they see that you're not really operating like a corporation. They will go after your personal assets. So very important to understand what piercing the corporate veil means. Last entity here is the C corporation. Now, the benefits of a C corporation is it has a fixed tax rate. Unlike all of the other entities that we discussed, the taxes that you pay are based off of your individual tax rate. So the more money you make, the higher your income tax bracket will be with all of those other entities because you're considered a flow-through entity. But with a corporation, you're paying a flat rate. Right now, at the time of this video, the corporate tax rate for C corporations is 21%. So it's pretty simple, but the downside to this is if you want to take money outside of your corporation, you're going to be taking what's called a dividend, which is taxable. So not only will you be paying taxes on the corporate rate, but you also be paying taxes on the dividends that you take outside of the company. And that's what we call double taxation, which is what we want to avoid. We don't want to be double taxed on the money that we're making. So this is one of the reasons why C corporations aren't highly favored typically. One of the benefits of having a C corporation is you're able to qualify for what's called an HRA, a health reimbursement account. Now, C corporations qualify for this. You're able to deduct a lot of your health costs that you have by having an HRA. If you want to learn more about this, be sure to like and comment below so I can make sure that we can actually do a deep video on HRAs and other ways to leverage your business and health expenses. So be sure to comment below. The other thing, as a C corporation, you're also able to make an election to be taxed as an S corporation as well. As I mentioned before, the S corporation is one of my favorite types of entities. So we just discussed how you can be taxed as a sole proprietor, general partner, S corporation, LLC, and a C corporation. Those are 5 different entities that you could consider for your business just getting started, or even if you're a seasoned business owner and you want to start understanding how to leverage each of these entities. The more you understand about these entities, the more creative you could get with your tax plan. So it's very important that you understand each and every one of these. Thank you for watching this video. Until next time, Jacob, your innovative tax CPA.